Hi, welcome to Strike. In this video, we are going to be talking to you about sentiment indicators, a very important part of market analysis. Where do you find it? Well, simply go to the left hand side and find this pie, and in the sub menu, you find sentiment indicators. When you click on it, a fresh tab would open up, and you see four sections here in which we split the various types of sentiment indicators. Now, what is a sentiment indicator? We are essentially measuring the buying and selling activity of different participants in the market or in the market internals to get a gauge of whether the crowd as a whole that is participating in the market has become extremely bullish or become extremely bearish or cautious on the market. This sentiment reading gives us a sense of where the market is in the overall trend and allows us to gauge which side should we take. Contrarian investing is easier said than done, but extreme readings allow us to judge when the crowd is on one side of the trade and it's time to move away and consider the opposite. So to get that idea, you really need to look at macro market data, which comprises all market data available. You can't simply depend on the 5 people that you speak to gauge what is the market sentiment. And a lot of this data is now available from the exchanges. We've measured and mapped it across different segments, some of it which are unique and not available anywhere. So let's get right into it. And today we are going to discuss first the participant positioning data. Now, participant wide data has become available from the exchanges since 2012, and therefore we can actually look at how each of the participants are behaving. Now, who are the participants? This data has been split into 4 types of participants by the exchange. The first one is client, which refers to individual clients, corporates who are all participating in the futures and options market. So yes, the participant wide data is essentially about the positioning in the futures and options market. The second segment is DIIs, or the domestic institutional investors, their positioning in the market. The third segment is FIIs, the foreign institutional investors, and their positioning in the market. And the fourth segment is the pro or prop desks, the proprietary traders who essentially set up a prop desk inside of financial intermediaries and their positioning in the market in the futures and options segment. So each of these data points are available, and we split them and we look at how to measure and map them historically. So if we are looking, we've actually divided each of the indicators into 3 to 4 subsets based on the data available. And the first one we look at is the client index futures long percentage. Now, when we say long percentage, it simply means that we are measuring the position, which is the amount of longs that the clients are holding as a percentage of the total positions, long plus short. Okay, so what percentage of their positions in the market in the futures side as a percentage are on the long side. So naturally that means that the rest of it is on the short side. Now, these ranges can change over time. As you have seen, historically the data prior to 2017 moved in a very wide range, and since 2018 we've sort of seen it within this range. So what we've done is we've put these red labels here which show you the general overbought oversold condition range within this period, which has been working consistently. So every time we have an extreme data point above the red range, then we are actually looking at a point where excessive longs have been built up. Now, what does that mean? It means that whenever clients, if you look at his history, you'll find that whenever clients are very long, that is often close to a market bottom. So you see these long positions, then you see these long positions. You'll find that long positions at around 64% are associated with a possible market bottom. The second one is to actually look at the net index futures contracts itself. So instead of a percentage, you can look at the raw data, which is how many contracts are outstanding at a point of time. Again, here, based on a historical perspective, we can judge that this is the oversold or overbought zone in which markets peak or bottom. And broadly, every time we are above this red line, which is when there are more than 100 and 120,000 contracts long amidst clients, we get to a market low. So this has happened here, it has happened here once, twice, thrice. Now, each point where you get an extreme reading doesn't necessarily mean it's a major bottom. Sometimes it can be a short-term bottom, sometimes it can be a medium-term bottom. Of course, that is a separate judgment call, but surely an extreme reading results in some kind of a counter trend move. So here, this extreme reading led to a short retracement rally, but here these extreme readings resulted in a much more significant advance in the market. Lastly, we can look at the client net index position. Now, the net index position combines the futures and options side. In the first two indicators, we are only looking at the long futures percentage and the long futures position in number of contracts. But if you combine the futures and options in value terms, then this is what we end up with, and this can also give us an insight. Now, the reason that we are using three different data formats is that sometimes one or the other data format might get overbought or oversold, but the other one might not, and having an eye on them is relatively important. So we can do this across segments. So we can move to the DIIs and look at the long percentage, just like we did in the client case, and we would get readings that could be extremely high or extremely low. So DIIs sometimes have become, were not very active prior to 2018, but after that they have become significantly active. Now, of course, the range, as you see here, has been constant, but when we look at actual number of contracts, you'll find they were very low before 2018 and became quite high after 18, which is why readings after 2018 are more relevant. But this is the broad range. Every time they are 80% or more bullish, it looks like the market tends to bottom, which means they build significant long positions into the low point of the market. This can be verified by looking at the index futures positioning. So if we click at the actual number of contracts, what you end up seeing is the actual positioning. Like I said here, if you go to prior to 2018, it's pretty much flat. You don't see the ranges like we saw on the percentage chart. But after 2018, we see very clearly, this range being maintained where a large number of contracts got built up. So almost 50-60,000 contracts long were associated with bottoms, a bullish positioning, and similarly, extremely low readings, less than 62,000 contracts short, have been associated with market peaks. Now remember, these ranges can change over time, but it gives us a general idea as to where we should start considering or studying other aspects of the market in terms of a potential top or a bottom. Now, just like in the case of client, we have split it between two. One is the futures percentage long. Now we've looked at the actual number of contracts, and then we look at the net position, which is a combination of futures and options. So this same methodology can be applied across segments. So now we'll go to the FII segment, which often gets people very attracted to what the FIs are really doing. And when we look at their percentage long, so we find that FIs tend to be bullish or bearish based on the percentage long. They tend to be extremely negative at market lows, very opposite to what we saw in the DII and client side, who tend to be bullish, extremely bullish at the market lows. And here we find the opposite, that they tend to have an extreme short positioning at the market lows, which in this case shows up as a percentage long. So when they are very low, like 7% only long was associated with this market bottom. And similarly, a very low reading here at 10% long was associated with this market bottom. And at the highs, we may find that the long position ends up being very high. Like here we had a peak long position, but again, this didn't end up being a major market peak. At the major market peak, there was a kind of negative divergence. So those are studies that we can do, but this broadly tells us how the FIs are positioned on a percentage basis. The second reading is actual number of contracts. So we can actually see how many contracts are long or short, and does it associated with previous highs and lows. And at points like this, you come to know whether you've hit a record. Like this short position of 1,98,000 contracts over here was at this point of time the highest on record. And prior high record was here during the pandemic, 1,73,000 or 74,000 contracts short was what we saw in the sell-off that we had in March of 2020 when the pandemic led to a shutdown. On the upside, similarly, we get long positions readings of 90 to 100,000 contracts long, often associated with market peaks. But again, prior data, if you go to before 2017, these readings used to go up to over 200,000 contracts. So again, a range change, something which is common in sentiment data, and we have to adjust accordingly. The FI net index position reflects the total futures plus options positioning. Okay, and this can have its own range. So we can actually reset. This range has been reset here to the interim period. We can have one more line down here, which would reflect extreme conditions that were seen prior to 2017. Lastly, the pro also did not have significant positions historically. We do see the data being rather erratic. So far, it has not given significant extreme signals. But that said, you never know when it becomes important. So when we look at the actual net position here, it's ranging between 40,000 short to 25,000 long. Compared to the other segments, this is probably the smallest position in the entire basket, which is why probably appears less relevant, but you never know. Like I said, it may change over time, and we may start giving it more importance, just like the DIA positions increased at a particular point in time. And lastly, the net index position, which is again a combination of the futures and options data to try and see whether we have reached an extreme reading in the data itself. The last one to watch out for is the sum total of clients plus FIIs. Now, why do we look at this? Is because the client and FII data were two of the largest segments for many, many years in the total positioning. So it just struck us, what if we take a combined position and look at where we stand, which is adding the total positions of the client side, the number of contracts, long short, with the FIs, long short, and then looking at the number of contracts open, long or short. So that's a combined positioning of the two. And at times we see that there is an interesting reading on the extremes, both sides, over time. And so this is why we added this right at the beginning as a combined indicator. And this one, we've put two red lines, and you can see there are certain extreme periods. We've come very close to this red line at this top in 2018. And then we've actually fallen below the lower red line at the bottom here, at the bottom here, again at this bottom in the pandemic, and more recently at this point. Again, we have a peak reading at this point and a peak reading at this point. So very interesting, gives us good lead signals, not just by looking at the individual positioning, but also the combined positioning sometimes, because one segment is long, the other is short, but how they combined, we sometimes find that both the segments are long, and are they long to a maximum degree? And that can be very, very different in terms of what we end up reading. So that is why we've added the combined positioning, client plus FII, as a final indicator to gauge what is really going on.